Hey, welcome everyone. Tom here from Park Avenue Trading, your chief dealer that keeps you sane in insane markets, giving you great price points to have trade setups at. And in this video, I'm going to be doing a video for posterity purposes, basically going to sit out on YouTube forever, even when I'm resting in the ground and my epitaph is on a tombstone. I gotta write my epitaph. I don't know. I gotta write something. I'm at price predictor or something, the Forex price predictor. But anyway, I'm going to be doing a video today on Fibonacci, which seems to be very, 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 very popular. So, but I want to go over, before I do this, I want to basically go over like what I had some marketing research done, and basically what the researcher came back with is said that there are a lot of courses that are out there that promise to simplify trading, and they end up overwhelming the student and with very, very hard to follow instructions or lessons. Okay, a lot of prices out there for courses are up, exceeding $1,000, up to $4,000 for Fibonacci. Holy smokes! I mean, that's a lot of coin, man. And many students, it says here, I'm just going to read it straight from the research. There are elite memberships out there that left many feeling their money wasn't well spent due to minimal improvement in their trading performance. In general, there's a sense that traders pay premium prices but receive content that lacks depth or actionable value. They often note that many free resources online are as good or better than what is covered in the paid courses. Pretty amazing, right? Lots of students want video courses to avoid overstraining the eyes. They don't really want to read ebooks. Okay, I get it, or read any type of books. I can get that because everybody has that like McDonald's mentality. Nothing against McDonald's, but what I mean by that is like, you want it now, and because you're hungry, you want the burger right now. That's why you go to fast food, right? So my takeaway from this is that you want actionable steps, and that's great. I'm going to give you actionable steps in this video, and I'm also going to be designing a Fibonacci trading course. Not an expensive course, but it's definitely going to be a course that does not cover what's usually covered in Fibonacci, even the free stuff on the web, or even in Fibonacci books. I'm going to give you proprietary information or proprietary systems that were developed using Fibonacci. The whole idea behind Fibonacci retracements is that price advances and declines do not continue uninterrupted. Contra-trend rallies and trend reversals occur all the time. Now, predicting the extent and the duration of the movements is what your analysis is supposed to do for you. But there's certain things you need to do in order to get the right levels. Now, the whole idea behind Fibonacci is that you want to be trading with the trend, the overall trend. Now, every time frame has a different trend, but the main trend, the big trend, the weekly trend is like the river that's running behind the short-term trend. Okay. Now, if you're trading 10-minute charts, you really don't care about what the weekly is because you're just going for a setup that's basically looking to give you X amount of pips per X amount of pips risked, and you don't care if the trend is upward on the weekly. You're not going to use a 10-minute chart to get long. Okay. Now, you could, if there is convergence of price levels that the weekly basically has a level at, and the 10-minute hits, then you're going to want to basically go with the trend and get long. Now, all well and good. So what exactly am I going to be covering in this video? In this video, I'm going to be covering something that we came up with back in, maybe 1990, probably before some of you guys and gals were even born. And it was a setup that we called at first the Whopper. And why it was called the Whopper was late after trading, 5 o'clock, even though trading was still continuing, our shift was over at 5 p.m. from 7 in the morning, 5 p.m. After 5, what we would do is we would get together on every Monday and Wednesday, and we would discuss as a proprietary trading group, what technical indicators, price-based only, that we could use that seemed effective to determine, a trend reversal, or an exhaustion point. That was really important for us. So what we did was we would order either from Jackson Hole, was a really famous place to get burgers from, but a lot of times it would take forever to get our food, and we, like McDonald's attitude, man, we wanted it now. So we would send the junior traders out, and I would always, since I was the chief dealer, I got to pick. I would always go for Burger King. Burger King was my favorite. So we would order Whoppers for everybody, fries, and of course my favorite was a strawberry shake. No wonder why I gained so much weight. But anyway, that's so it was originally called the Whopper. Then we said, well, all right, it morphed into something called the head fake. And it's a very simple technique that I'm going to show you today, which you could use with Fibonacci levels, and you could use with pivot points, pivot point analysis. When you just run, you could do Camarilla pivots. You could use whatever type of pivot that you want. With this, you could use the pivot point that I showed you in a previous video, where you're taking the high to low plus close divided by 3. That formula, or the more advanced formula, however you want to do it, you could do it. So we're going to just be going over what's known as the head fake. All right, so what is the head fake? The head fake is, one, you got to be doing it with whatever the market structure is saying at the time. So in other words, whatever the trend is on the instrument that you're trading on that time frame. So if you're trading a 1-hour chart, now I have up here Swiss yen, and I just threw this chart up because it's not one that I normally trade, and it doesn't have any real it has no markups on it because I don't have my levels that I'm interested in. I probably will cover Swiss yen because Swiss yen is a wild currency. I mean, a wild cross. And I just haven't been following because I'm only one guy. And it's you can't, if you have too many currencies that you're following, it's like kind of like herding cats. Then the idea behind herding cats is you take a cat and you put him in the corner, and then you go to get your other cat, and that cat left, and you put that cat in the corner. Then you're trying to, you just can't do it. It's just too much. So I stick to 4 primary currencies that I watch and that I put out even on my daily YouTube channel, where I'm doing analysis for euro dollar, sterling yen, euro yen. Now, I recently just added euro dollar because people asked me for it because it's been quite quiet, and it still is quiet. Sterling dollar also has been very quiet. But anyway, let's get back to the lesson. Okay, so what we're doing with this is we're comparing 2 consecutive up close bars or 2 consecutive down close bars. And all the head fake is saying is that if we have 2 bars that are consecutive down closes, so I'll give you an example right here. We got those 2 bars that we have 2 consecutive down closes on. Down close, next bar, down close. Right? Simple. What we're going to do is we're going to measure the difference between the close of the first bar, this bar right here, I'll put it up here, the close of the first bar to the low of the bar. All right, so how come that didn't work? Sorry. The close of the first bar to the low of the first bar. Okay, and I'll do that. Let's do that just so we do step by step because we want actionable steps, right? So I'm going to do the action, and then you're going to be able to go out there and do this yourself to basically see how valuable this piece of information I'm giving you is. So let's get rid of this so we don't create confusion. So the close of this bar is 171.10, 171.10. And the low of the bar is 170.98. That is 12 pips. The next bar, the next hour, we do have a down close, and the close of that bar is 170.94. And the low of the bar is, I'm sorry, the close of the bar is 171.09. And the low is 170.94. That's 15 ticks. So the difference between bar 1 and bar 2, this was 12 ticks. This was 15. It's only a 3 pip difference. That is saying that this low should hold. So in other words, what the head fake is saying is that since this went a little bit deeper than this should hold because it basically, we're measuring the distance between the close and the low, close and the low. So we're saying that that's deeper. The second bar was deeper. So therefore, that low should hold. Okay? Now, you could see we have a really nice reversal. We could do the same thing. Now, okay, so you say, all right, so I got 2 consecutive down closes, right? And the low, the difference between the low of bar 1 and the close of bar 1 was less than the low between the low of bar 2 and the close of bar 2. So it was less than this. So therefore, this one should hold. Hope that makes sense. So I confused myself there. So the close of bar 1 to the low of bar 1 was 12. The close of bar 2 to the low of bar 2 was 15. Because the low to the close of bar 1 was less than the low to close of bar 2, bar 2's low is basically saying it should hold. So therefore, you should be looking to get long on the open of the next bar with a stop below the low of bar 2. That's an actionable thing to do. Now, you say, well, where do I know to do this? Well, basically what you could be doing is you could be taking a fib retracement, and you need to know how to do that. There are ways to do it, okay? So you would need to basically look at the market structure itself. This has really been in a downward movement, right? So really, we should be looking for head fakes on the other side. But you could take head fakes from any any side, I mean, but you just got to realize that if you're in a downward moving market, you really want to be looking for the opposite. You want to be looking for, and we're going to be going over that in a second, which would be 2 consecutive up close bars that we compare them to. Okay. And actually I see one right here. That's a great example. And not all examples work. I mean, not all these things work. Okay. If it did, I wouldn't be giving out to you for free. You'd be paying more than the $4,000 that these people are charging for Fibonacci courses. That's for sure, because I would have the golden key. And this is not a golden key. This is just a way of analyzing the market. So I really hate these cups my girl bought. I mean, they got these characters on them, but they're big. That's why I like them. So anyway, so we could take a Fibonacci retrace. All right. So we could say, all right, so we could take a previous high we can go back in time to the low, right? And we can get an extension on it. Hang on. So what I did was I went back, I got an extension, all right, and I got the extensions down, and this thing's down to 2 at this point of this trade. So it's really extended pretty far down, but here was the basis of our trade right here. The difference between this close and this low, this close and this low, this is greater, this should hold, and now we have the retracement back up. So that worked out really well. Congratulations. Hindsight's 2020. So, but anyway, let's say we're basically saying, all right, let's get rid of this Fibonacci retracement just to not clog it up. So here we are on this movement up, all right? And here's one that actually fails, okay? But let me go over a better example of one that works, right? Everybody likes to use the ones that work. So on this leg, all right, if we wanted to get Fibonacci retracements upward to basically see what level we're at, we could do that. So let's do that. And here we go. We just ran a quick measurement of the leg for retrace values. Now, if you remember, I told you that coffin box usually occurs between 618 and 0.82, which worked out perfectly. But here's our little indicator that we call the head fake, all right? So I got 2 consecutive up closes. I got one that closed right at the top. I got one that broke through the 0.82, but the difference between this close and this high is 0. The difference between this close and this high is obviously greater than 0. This close was, the high was 173.91, and the close was 173.64. So that was 27 ticks. So basically what this is saying is the exact opposite of what we said on the 2 down closes. Since this is greater than the previous, that top should hold. So we have confirmation of when we hit the 0.82, my level, I told you to change 0.786 to 0.82 on your tool. It's better for skid. We have that confirming that top should hold. There was the sale right here. Now, obviously, it was great, right? I mean, but that's not what I'm here to do. I'm not here to say, oh, I'm giving you the magic clue. I'm not. I'm giving you tools that you can actually go and take what people are complaining about. Like, there's no actionable steps. There's no straightforward steps. This is a straightforward step at a Fibonacci level using what I call the head fake. So please, if you like what you see, like and subscribe, give a big thumbs up, leave some comments for my videos. If you haven't been following me and you are an active trader, I do not put out, entertaining videos. I put out market forecasts, which have been really spot on. If you've been following me, go back in time and look, and then go look at the market, what it did. I'm very proud of my market analysis. It's basically what I do. I basically look for where price advances and declines exhaust themselves, or the next moment of like the next important level, that if a market gets over it or under it, it's going to either go down here or it's going to go back up there. My last trade call, sterling yen. I'll even put it up. Let's go to the most recent call. I said when we were here, I said if we broke 190.65.70, we were going up first to the 90 level, and then there was exhaustion at 191.20. Okay, 191.20. The high was 191.25. All right, 5 pips off before the market did a beautiful retracement back down almost to the point of origin. Okay, that's all there on the video. Go check it out. That was for November 29th, 2024. So please, if you like what you see, like and subscribe. Don't forget to ring the bell so you don't miss any of this important information that I put out. I look forward to seeing you guys in tomorrow's analysis, where I do the weekly analysis for the up and coming week. And then we start all over again on Monday for the daily analysis. And remember, always enjoy the party, but dance near the door. Cheers.